It might have been the largest pharma merger ever, combining U.S. corporate giant Pfizer with the smaller, Ireland-based company Allergan, the maker of Botox. Those plans fell apart after the Obama administration implemented potent new regulatory restrictions on U.S. companies as part of its effort to halt inversions.
It's not that they're breaking the laws, it's that the laws are so poorly designed.
Inversions is the term for deals in which a U.S. company attempts to move its tax address out of the United States by merging with, typically, a smaller foreign firm in a country with a lower corporate tax rate.
They effectively renounce their citizenship.
Though the combined company's executives and many of its operations might continue to be in the U.S. Inversion deals offer companies two main tax benefits. One, they no longer face any U.S. taxes on profits generated outside of the U.S. Two, it enables them to avoid U.S. taxes through so-called earnings stripping. What is earnings stripping? It's a maneuver in which a corporation with a foreign address loans money to its U.S. subsidiary, which in effect is to itself. The U.S. subsidiary pays interest on that loan, which it's then allowed to deduct from the taxes it owes on its U.S. earned profits. Since the U.S. corporate tax rate is 35%, being able to deduct the interest payments can save it a lot of money. By comparison, the corporate tax rate in Ireland is 12.5%. The interest that the U.S. subsidiary pays to its Irish counterparts is then taxed by Ireland, but at a rate that's around a third of what it would be in the U.S. So, in effect, by being able to deduct this interest from its taxes, the company lowers its share of U.S. income and increases the share that's taxed abroad at a lower rate. How do the new regulations change this? The U.S. government now has more authority to treat debt transactions as equity under the tax code. So companies may not be able to deduct as much of the interest they're paying as they used to. And it's not just inverted companies with U.S. roots that are affected. All foreign companies that have operations inside the U.S. and take advantage of this tax-lowering mechanism could face a higher U.S. tax bill. Also, this new regulation doesn't just affect future inversion deals, it also impacts deals that have already been completed and forces companies considering deals to rethink them. Look no further than Pfizer. That's the short answer.